This scene from the movie The Impossible about the tsunami that struck the Philippines perfectly describes the inverted yield curve. What is the inverted yield curve? This funny looking chart. Well, it's one of the best indicators that economists use to predict an upcoming recession. And if you ask ChatGPT, specifically in the past 50 years, an inverted yield curve has correctly predicted each of the last 8 recessions in the United States. In my opinion, the inverted yield curve is the #1 predictor of recessions. But what the is it? In this video, I'm going to explain to you what the inverted yield curve is like you're 5 years old. I promise you, by the end of this video, you'll fully understand what the yield curve is, how it can get inverted, and why when it gets inverted and it starts to uninvert, it means we are entering into a recession. And by the way, if you didn't know this, the yield curve has been inverted for the past 2 years, since July of 2022. But here's the crazy part. We just uninverted. And a look throughout history will show you that when the yield curve uninverts, goes from inverted to uninverted, we get a recession. In 2006, the yield curve uninverted, inverted, uninverted, and then finally, when it fully uninverted, after 1 year, we got the Great Recession.
Okay, Max, I understand how important the yield curve is, but what is it?
The yield curve takes the interest rate of the 2-year US Treasury and the 10-year US Treasury and just compares them. Right now, the 2-year US Treasury is paying 3.56%. And the 10-year US Treasury is paying 3.71%. And for those of you that don't know, and that's totally fine, a US Treasury is simply US debt. It's when people like you or me lend the government money so the government can go spend it and waste it on stupid shit. But the government gives you an IOU.
Hey, we're gonna pay you back, and we're always gonna pay you back. We've never missed a debt payment, so it's assumed to be risk-free.
The only risk-free investment there is. And for doing that, they're gonna pay you a little bit of interest, a little bit more money. So if you lend them $100 at the end of the year, they're gonna pay you, well, let's see. They're gonna pay you 3.56% if you lock up your money for 2 years, or in that case, $3.56 per year. Or if you decide to lock up your money for 10 years with the US government, they'll pay you $3.71 per year for the next 10 years. This is normal. I mean, really think about it. If you lock up your money for 2 years versus locking up your money for 10 years, you would expect to get paid a little bit more of a premium for locking up your money longer. That makes sense. If I'm not going to have access to my money for the next 10 years, I want to get paid a little bit more every single year than if I were to just lock it up for 3 months or 6 months or 12 months or 2 years, right? That makes basic sense. But here's the thing. Once in a while, once in a blue moon, guys, the economy will flip backwards. It will invert. And long-term bonds, literally 30-year bonds, will pay less interest than 3-month bonds. Don't believe me? That's still happening right now. You can lock up your money for 3 months and you'll get paid 4.69%. But if you lock up your money for 30 years, you don't get a premium. You get an anti-premium. You get 4.04%, more than 0.5% less. So why is that? Well, that is an inverted yield curve. Well, that is a 30-year, 3-month inverted yield curve. But what economists look at is the 10-year, 2-year yield curve. But why would it get inverted? Why would anybody lock up their money for longer and want to get paid less? Well, I actually did that. I bought a bunch of 5-year treasury bonds and I actually made a great return on them. Even though 3 months were paying less, I locked up my money for 5 years. Why? Because the recession is coming and I knew that. And I knew they were going to drop rates, which they did. So my bonds went up in value. Because now everybody wants my bonds because everybody else has to buy super low rate bonds, whereas my bonds, they're still at a higher rate. So even though sure, they're less than 3-month bonds, they're the best 5-year bonds you can get. But that doesn't answer the question, why do people want those 5-year bonds in the first place? I get that you just made a smart trade, Max, but why would you even lock up your money for 5 years in the first place? Guys, let me explain to you like you're 5 years old. So now let's flip back over to the movie The Impossible and let me show you that clip one more time. This is going to explain the inverted yield curve in a way to you that you're never going to forget. Pause right here, guys. Look at the top floor of this building. It's perfectly intact. Anybody living in the top floor of this hotel would have survived the tsunami. What if you were booking a vacation to the Philippines and you were looking at hotels, you stumbled across this awesome hotel on the beach, and you noticed that the top floors were more expensive than the ground floors? That would be odd, because at beach hotels, the ground floors that are on the ground, like on the beach, that literally you step out your back door and you are on the beach, those are always the most expensive rooms. But what if you were booking your flights, you're looking at the hotel and you're like,
wait, why is the top floors of every single room more expensive? Something would be wrong.
Maybe the market would be pricing in, the economy, the market would be pricing in a small chance, or maybe a big chance, depending on how expensive those rooms are, of a tsunami, of a black swan. I mean, think about it. Imagine the top floor rooms were $1,000 a night, but the bottom rooms, the best rooms, were only $50 a night. You'd be like,
wait, something's wrong. This is inverted.
When the 2-year bonds are paying more than the 10-year bonds, it's the market screaming at you that there is a tsunami coming. That tsunami is a motherfucking recession, and it is going to destroy everything. And investors are willing, like myself, are willing to buy 5, 10, 20, 30-year bonds that are making less money just to be able to lock in that rate. Why would we want to lock in that rate? Well, we would only want to lock in that rate if we think that rates are going to keep going down, right? And what happens with every recession? Here is a chart of interest rates dating back to 1955. And as you'll see, every time rates go down, we're followed by a huge recession. It happened in 1957. It happened in 1960. It happened in 1970. It happened in 1973, 1980, 1981, 1990, 2000, 2008. And don't you forget it, it also happened in 2020. So let's zoom in here and imagine this is you, right? Right before 2008, and rates are maybe around 5%. Imagine you're in 2008, and let's just say that the 2-year bond was at 5% and the 10-year bond was at 4%. Well, you'd be to buy the 10-year bond at 4%, right? Why not buy the 2-year bond at 5%? Well, if you bought the 2-year bond, you would only get 5% for 1-2 years, and then you would have to renew at 0% essentially. Whereas the 10-year bond would continue to pay you 4%, let's say, for the next 10 years. Way higher than everybody else is making, way higher than the Federal Reserve is offering you. So what the inverted yield curve tells us is that the market, the smartest investors of them all, are bond investors. They are way smarter than Tesla and Bitcoin stock investors. Sorry, don't mean to call you out, but bond traders are fucking geniuses. And if they're willing to take less amount of money to lock in a long-term rate, you better be careful, because what they're saying is there is a high chance that rates are going to crash. And why would rates crash? Because of a recession, because of a incoming tsunami. They're willing to pay $1,000, $2,000, $5,000 a night for the worst room just in case, because they think that that tsunami is coming. So all the inverted yield curve is the bond market telling you that rates are going to collapse here in the near future. And rates only collapse for one reason: because we are in a recession and the Federal Reserve is panicking, trying to chase after the damage that they've already created through their terrible monetary policy, because these elitist think that they are somehow smart enough, a group of middle-aged male economists are smart enough to run the entire United States economy. Those pompous when they should just leave the economy alone, not fucking touch it and let you and me run the economy. But they don't do that. So the bond market is calling their bluff. They're saying, you guys fucked up and you guys are about to drop rates super low, and I am going to make a lot of money because what I'm going to do is lock in a long-term rate. Even though it's paying less, I'm going to lock in a long-term rate, and once rates drop, everybody's going to want my long-term rate, and they're going to pay me a huge premium for it. And the reason why this curve gets inverted is because more bond investors are starting to think that way. So more bond investors are actually now starting to buy the long-term bonds. They're starting to buy the 5-year, they're starting to buy the 10-year, they're starting to buy the 20-year, they're starting to buy the 30-year. And the more they buy the bond, the higher the price goes. And the higher the price goes, the lower the rate goes. So all it is more people chasing after less quantity of goods. All it is supply and demand. All it is bond investors, everybody piling into the 10-year bond and no one really wanting the 2-year bond. Everybody buying that 3rd, 4th, 5th floor room at the hotel and nobody wanting the 1st floor room. And what I want to leave you with, everybody, is the tsunami is most dangerous when the tide pulls back in, not when the tsunami hits. It's when it pulls back in. That's unfortunately where most people die. The yield curve is the most dangerous, not when it inverts, but when it uninverts. We get recessions when the yield curve uninverts. And guess what just happened? The yield curve uninverted. The 2-year bond is paying more than a 10-year bond.
Max, that's good. Max, that's normal. Max, the tsunami is drying up. It's going away.
Well, it's about to pull everything into the ocean and destroy everything. And the recession is about to pull everything into its deep, dark, black pit. I hope this video was helpful, everybody. I hope this helped you understand how the inverted yield curve works. If you want me to make more economics videos like this where I break down really complex topics into easy to understand, digestible concepts, let me know. Happy to make more of them. Please subscribe to this channel if you appreciated this video. I make a lot of content, mostly on real estate investing and wholesaling, but here and there I just got to drop some economics bombs because, dude, we're entering into a bad recession.